Goldman Sachs is harvesting their portfolio. Translation, they're selling stocks. You came here for the truth, so let me unveil that for you. Today, first things first, we need to talk about Goldman Sachs. They have sold a portion of their equities portfolio, a large portion in fact. I'll break that down for you here. The second thing, of course, it's inflation. Inflation is running hot right now, hotter than what they expected, hotter than what all of the economists said would happen. Let's talk about that. And number three, we are going to talk about bubbles. Of course, those two correlate. So all of these, in fact, are part of this one structure that I've been alluding to for so long. Let's go. If you've been here on the channel for a while, you know that I always bring you the sources directly. The alternative doesn't do it anymore, and the mainstream never did it in the first place. But what I am bringing to you here is directly from GoldmanSachs.com. You could see this PDF. This is the 2021 second quarter results. And they pulled this up, giving you some charts and data and so on. But what I wanted to show you might be a little bit confusing on the chart here is essentially what they've been doing. Asset management, let's take it from the top. Asset management, harvesting, funny word to use, progress of balance sheet equity portfolio. So this is year end 2020, okay? Equity investments, you got $20 billion. And then you look at this here, they made an additional approximately $5 billion. The stock market has gone up, you know that. And then you look at, this is by the way, year to date position. The markets have done well, maybe their trading has done well, and so on. Then you look at what they've added. So they've bought $1.5 billion worth, but I believe most importantly is in this year, and that is $5.5 billion worth of sales. That is massive. Now, as you can see, second quarter 21, equity investments looking at about $21 billion. So they've effectively brought themselves back to where they were during this period. They've done well, essentially. They're trimmed some off the top. But I must ask the question, when they sell at a pace they haven't done since 2007, 2008, should this ring any alarm bells? What does it do for you? Put that in the comments below. Let's just talk about this here. You have seen an incredible rise in the stock market, the real estate market, and so on. And of course, there have been some that have said it's running too hot and maybe now's the time to take some profit off the top. No, they're not going to go and run for the hills. They're not going to go and wait in their bunker, but they're simply trimming off the top. There are others that have said, we've taken so much of the future profits up until the present that there looks like for the next 10 years, there's simply no growth there. That's never a good thing when you look at it in the future for buying a particular asset. You must be able to address the value. What value is this particular investment going to give me over the next 5 years, 10 years, 20 years, and so on? And in that case there, I could understand what they're up to, but we don't really know, okay? So if they come out with any public statements, we'll see, but I just found it extremely interesting to see the pace at which they've been selling. Now, could it be related to what we have been seeing throughout this period related to inflation? Inflation climbs higher than expected in June as price index rises 5.4%. I think it's important to note at this point here that all economists, for the most part, all the mainstream ones, have said that inflation, it's transitory, it's temporary, don't worry about it, this is going to be over soon. 5.4%, the biggest monthly gain since August of 2008. Of course, that's when you had oil near $150 a barrel. We're not quite there yet. Excluding food and energy, inflation increased 4.5%, the largest move since September of 91. Of course, you want to get rid of food and energy because, nobody uses that stuff anyway. And then we have the actual chart. Look at that escalation. It's incredible. Now, yes, I understand. I get it. We're talking about year over year increases, but just take a look at that 5-year chart. Bring it back 10-year chart. We haven't seen anything like this before. Pulling it back all the way, you could see we were at this level just for a brief period in 2008. Will we exceed that? It's looking like that's the case. Only time will tell, of course. This is just showing you the top contributors to the percentage change. So again, Money GPS, I don't just give you the headlines. You already probably knew the headline before you watched this video, but I break it down so that you actually have the knowledge, so that when you're talking to somebody and they say, whatever mainstream opinion, and they're trying to convince you based on a real opinion, not data, you've got it all. You've got all of that, and you can make your trading decisions based on that. Okay, anyway. Headline month over month, that's the black line, but it's broken down. Gasoline, meat, poultry, and fish, new vehicles, rent a shelter, used cars and trucks, and other. And we'll talk about the used cars and trucks specifically. I believe I brought it through in here. The cost of living post the biggest surge since 2008, the CPI shows, as inflation spreads through the economy. And importantly, as they say here, the cost of used cars accounted for more than 1/3 of the increase. But prices for food, energy, clothing, and plane tickets and hotels also rose sharply. A lot of the restaurants, what I've noted, and please tell me in the comment section below, restaurants have increased their prices. Is this just anecdotal evidence? But I don't know. You tell me. I believe that's the case. This is just more showing you the same out of the Wall Street Journal. Inflation accelerates again as economic recovery continues. That's not why, by the way, but they'll say that. One of the things about the cars, they literally said this. I don't think I have this one loaded up at this point, but it said the stock market is willing to ignore this because when the data came out, it showed that, well, it's used cars making up more than 1/3 of that. Therefore, there is no reason to worry. But let's be honest. Is that something that affects people in that way? Are you buying used cars every month? Like, think about that for a second. It doesn't even make sense. I get it that it's part of the basket, but shouldn't food and energy be part of that to a greater degree, that we should be putting more weight on that? The prices have not gone up 5.4% in food and 2% in food and 1%, these different stats that they show us. By the way, this person here is wearing Rugrats clothing, which I found interesting. But anyway, that's a side note. Now, I was reading through this Barron's article and I see this quote. While previous releases mostly showed price increases in a few energy-related areas, it appears the June increase was more broad-based in nature with spillover into the core components of CPI, notably the services component. And then it says basically, Powell is going to have to come out and hopefully say that everything's transitory. But then if you look at the top left corner, it says, this is a link to another article on Barron's. It's getting harder to argue inflation is transitory, but Powell will likely try. I just thought that was so hilarious because that's exactly what's going to happen. And then last, before we move on into what's going on with stocks and so on, I just have this one, just giving you a little bit of an idea. The chart at the bottom, upside surprise, US core and headline inflation were both higher than expected in June. And you can just see how this has been broken down since 2019 up until today. Clearly, 2020, things came down, they got hot, and then you could see where we've been ever since. Prices paid by US consumers surged the most since 2008, and importantly, the important part, topping all forecasts and testing the Fed's commitment to sticking with their ultra easy monetary policy. So we'll see what happens in the future here, but they're running out of time as we move closer to September. I've told you, watch for September. Number 1, Goldman Sachs. Right now, they're selling a lot of stocks. Number 2, the last time this was done was back in 2007, 2008. What does that tell you? And number three, this comes at a very interesting time because most economists are saying that inflation is transitory. Put it all together and it starts to tell a story. We don't know what's going to happen. We don't necessarily have to believe that a 50% crash or greater is happening, but certainly they're taking the other side of the bet. Who's buying right now? That's what we need to figure out. The EPFR, Lipper, Refinitiv, they pull out this data and certainly people are buying. But number one, the retail investors have been buying more than ever before. I need to move quickly through this. Just going to show you here that US stocks fell. Bonds rose on Tuesday as investors recoiled from another hot inflation report and earnings out of some of the big banks. They do get into more of the details if you want to see specifically what happened, but the way I saw this was that the market is simply ignoring everything. They're ignoring everything at this point. One day down, don't worry, just buy the dip. I think it's more important to focus on what's happening with debt. Governments worldwide gorge on record debt, testing new limits. An enormous pile of savings makes it possible for nations to borrow heavily at low cost, defying worries about inflation and sustainability. You can't have too much debt without the repercussions. That's what they won't tell you. Because of course they say, look, we got a budget deficit of $3 trillion. We are going to deal with it by growing out of it. Japan's central government debt is about to surpass a quadrillion yen, or nearly $10 trillion. Even with the total public debt of over 250% of the GDP, they spend no more on interest each year than it did in the mid-1980s when public debt was around 2/3 of the GDP. The world has changed. The intellectual frameworks have evolved. We don't need to worry about debt, okay? So what you should do is you should listen to them because they told you the truth in 2007. They told you the truth in 2008. They told you the truth in 2009. Sorry, hold on. Straight face. They told you the truth in every previous cycle. What about when you had Ben Bernanke? Ben Bernanke, I'll never forget this. I'll never forget this in my life. They had him up there testifying. And I don't know if it was Ron Paul or somebody else. They said, tell us who you gave the money to. Tell us who you gave the money to. And he was pushing him. And he said, no, we gave it to banks and financial institutions all around the world. He refused. The Federal Reserve refused to tell the Congress, effectively the people, who got their money. You should be upset. I was going to use a different word. You should be very upset at what the Federal Reserve does. But instead, people cheer it on, and that makes me sick. I feel like throwing up. Popeye's stockpiles chicken meat ahead of nationwide nugget debut. Okay? If your chicken prices go up, this apparently is to blame. McDonald's owners offer tuition and childcare to lure burger flippers. I'm going to tell you right now, this right here, because of Flippy the robot, because of all the other automation robotics, this is going to change in the relatively near future. $30,000 for Flippy the robot, and it's going to replace all those jobs. This feels like 1999 global startup funding frenzy fuels fears of a bubble. In March of last year, venture capital firm described this situation as a black swan of 2020. Fast forward a year later, tech investors are writing bigger checks than ever before. We should have been more cautious because 2020 showed us that things get very bad very quickly. If anything, for any reason, we want to learn something from the economics and the stock side of it, things happen faster than we can deal with. This feels a lot like 1999 to me, but the truth of the matter is, after 20 years, people forget. Okay? They do talk about the details of that if you're interested. But look, you can see on the charts, S&P 500 tech price to the sales ratio, and you just look at that, comparing that to the S&P 500. It's unbelievable to see the tech components of that, how far they've accelerated back into the levels we haven't seen since the tech bubble. Margin debt balances have exceeded anything we have ever seen before in history. And then this, like a sine wave, you could see that there's this flow. We go into a point which is, as they mention here, greed, and then we come down to a point of fear. Nobody ever knows where we are in the cycle until we look back in the rearview mirror. But I just wanted to show you this. If you want to pause it for yourself, I should put this on my Instagram and Twitter and so on, because I think it's really good. But I'm going to end the video. But I just wanted to mention the fact that I have this thing called the Insiders. Have you heard of it before? I'm sure you have. A lot of people are annoyed. It's fantastic. So what this is basically my way to get to you. They're censoring, they're blacklisting, they're shadow banning, they're doing all kinds of funny stuff. What I do is I get the email directly to you, and you get the video of the day. Very soon, it's going to include original information, so you can't miss it, because there's information not available on the videos, okay? So all you gotta do, sign up for free at themoneygps.com. If you found the video informative, hit that thumbs up button. By clicking that button on your screen, you support me. I wanna thank you for that. And if you haven't seen this video already, you can simply click here, and I'll see you there.